G'day guys, welcome back to the Devon Too Good investing channel. In this video today, I want to go over Alibaba Group's December quarter 2022 results. We're going to talk about how they did and what we can expect moving forward for the rest of the year. So guys, let's get right into it. Revenue, it grew 2% year over year for the business, and Alibaba, they actually split out their revenue into multiple segments. We can see that the China commerce segment revenue decreased 1% year over year. This was primarily due to weakening demand for goods purchased on Taobao and Tmall, the two largest e-commerce platforms in China that Alibaba own. International commerce, it grew 18% year over year. This was primarily due to good growth shown in Trendyol, the Turkish e-commerce platform that Alibaba is growing. Local consumer services, it grew 6% year over year. And within this segment of the business, they have AMAP and Ulama. And then you got Kainao, which is their logistics business, and this business performed very good. It grew 27% year over year, and this particular business is starting to expand out internationally. The cloud business, this was probably the most disappointing segment, and where a lot of people probably expect growth to come from, or at least they're hoping that growth will come from. This part of the business only grew 3% year over year. Then we've got the digital media and entertainment and innovation initiatives, which no one really cares about. One of the big themes you'll notice within this earnings report is that Alibaba has put a big emphasis on efficiency as well as reducing expenses, and as a result, that has led to income from operations increasing 396% year over year. Essentially, they're not investing quite as aggressively into the business at the moment. Instead, they're focusing on efficiency and driving profit. We can see here they've also reduced their share-based compensation expense year over year. And overall, this resulted in a diluted earnings per share of $2.24. I will say this is the GAAP measure, and that resulted in growth of 76% year over year. So if we look at the cash flow statement here, in the December quarter of 2022, Alibaba produced $11.8 billion in free cash flow. You got to remember, this is a non-GAAP measure. This does not account for the share-based compensation expense. So that's something to keep in mind. And in terms of share repurchases, they have been more aggressive on that front compared to last year, and they repurchased $1.3 billion worth of stock. Honestly, this isn't bad by any means, but given the amount of cash that this business has and how profitable it is, I would like to see them be more aggressive in terms of buying back shares, especially when the shares, in my opinion, are trading, undervalued. In terms of balance sheet, 28 bill in cash on the balance sheet, 45 bill in short-term investments, and they've also got long-term investments. Currently, they're worth about 60 billion. Company holds $24 billion. No, 20. Sorry, that's not 24. About $25 billion in debt. So just on that alone, they've got like $100 billion in sort of net assets. I guess you could say. I guess the long-term investments aren't liquid, but this is still value within the business that we obviously shouldn't ignore. Now, if we look on to these segments individually, first up here is our China commerce. As we mentioned before, this includes Taobao and Tmall. These are the two main big dogs. The China commerce retail business, the revenue did decrease 1% year over year. And the customer management business revenue decreased 9% year over year. This was mainly due to, as we mentioned before, lower demand on Taobao and Tmall. And this is pretty much, well, they're blaming it on soft consumption demand as well as ongoing competition. Their competitors include JD.com and Pinduoduo. We've also got to keep in mind that in the December quarter, it was affected by COVID-19, and this obviously put pressure on all Chinese businesses and their economy in general. And we can see here that EBITDA, it increased 1% year over year, and this is mostly due to reduced losses in their Taobao deals, Freshippo, and Taocaicai, and margins pretty much remain stable. In terms of international commerce here, it increased 26% year over year for their international commerce retail business. This is mainly due to the performance of Trendyol. This increase in revenue from Trendyol was pretty much due to robust year-over-year order growth, as well as them becoming more efficient with their use of subsidies. In terms of the international commerce wholesale revenue, aka Alibaba.com, this business remains stable. I don't expect this business to grow too much in the future, but it is what it is. And then in terms of adjusted EBITDA, they reduced their losses down quite significantly. So in 2021, in the same quarter, they lost 2,917 million RMB, and they reduced that loss to 763 million RMB. And this is pretty much them becoming more efficient within their business, reducing these losses, increasing the margins. We'll note that Lazada, their Southeast Asia e-commerce platform, I remember it's not in this presentation. They probably intentionally left it out, but within their transcript, their earnings call transcript, the Lazada business did deliver quite disappointing results, and it's quite frankly getting outcompeted by Shopee, which is another e-commerce platform that operates in Southeast Asia, and that platform is owned by Sea Limited. Just keep that in mind. However, it's good to see the Turkish business here doing quite well. Local consumer services, as I said, it is made up of Ulama, AMAP, and Fliggy. These are loss-making businesses. I think they're being affected by COVID and some of the restrictions going on there. You would expect and hope that these businesses in the future will grow faster than 6% year over year. But what is positive is they have reduced the losses that these businesses are creating. We can see that there is a 30% year over year improvement in adjusted EBITDA. In terms of Cainiao is the domestic and international logistics service, as well as it offers supply chain management solutions. It increased its revenue 27% year over year, which is very impressive. The business pretty much breaks even. Look, I'm happy with the performance of this business. Not much else to say here. Cloud. This was the most concerning aspect of the earnings report for me. It grew 3% year over year, driven by a apparently healthy public cloud growth, partially offset by declining hybrid cloud revenue. The company has made a shift from, it seems like they've, sort of not considered lower quality customers. They want to drive high quality recurring revenue growth. Look, I don't know exactly how that kind of works, but if we have a look here, their non-internet industry segment of their cloud grew 9% year over year, and it now contributes 53% of the overall cloud revenue. So the internet industries. You can consider this financial services, education, and automobile industries. And then the internet industry declined 4% year over year. This is mainly due to a top internet customer that has gradually stopped using their cloud services for its international business, aka TikTok. This has been affecting Alibaba's internet industry cloud business for quite a while. It's been a couple of years now. But on the fortunate side, this decrease in revenue is partially offset by improving demands from other customers in the China internet industry, and the business is now profitable. We've got a adjusted EBITDA margin of 2%. In terms of this, most of the Alibaba growth was expected to be in cloud when I made the investment. This hasn't really played out so far. Based off what I know, it would be very strange to me if China does not have significant growth in cloud, especially considering that a lot of the Chinese businesses are still using the old sort of IT hardware, and it's the next logical step for these businesses to transition from the old hardware to cloud. It's happened in the United States, obviously, with AWS, Microsoft Azure, and Google Cloud. I just find it hard to believe over the next 10 years China won't make this transition, but you never know. And it's hard to believe that when China does make this transition, that Ali Cloud isn't a big part of that transition. And then we've got the digital media and entertainment business. Don't really care about this. I'm glad they've pulled back the loss making here. It's pretty much a break-even business now. And then in terms of innovation initiatives and other businesses, they have also decreased the losses here. I believe they're doing a lot with AI in this particular segment. So guys, overall, if we think about valuation now, I'm not going to do a proper valuation, but just off the top of your head, just think about it, right? Companies trading at about $240 billion US dollars at the moment. We got the cash and cash equivalents of 28 bill, 45 bill in short-term investments. We got the 60 bill in long-term investments. We got the 25 bill in debt. That leaves us net about 100 bill. You take that 100 bill from the current market cap, so 240 take 100, leaves you about 140 this year. It's very likely that Alibaba will produce free cash flow of likely around 20 billion US dollars, in my opinion. They're going to obviously continue to buy back shares. I think the shares that they buy back will easily negate any share-based compensation, and I think the share count will come down. I expect overall growth, likely in the single-digit range for 2023. Obviously, there's a lot of headwinds right now. However, GDP in China is expected to be around 5% in the year 2023 as they reopen from COVID and all that drama. But, if you divide 140 by 20 bill in free cash flow, that gives you a price free cash flow of about 7. Whether you think that's appropriate for this business, well, that's up to you. Anyway, guys, thanks for watching. Hope you enjoyed and have a good one.